Looking to make some extra cash without breaking the bank? With just a small investment of $25 per week, you can start your journey to earning over $5,000 a month in passive income. Yes, you heard that right. It's possible through smart, consistent investing. In this video, I'll dive into the details of the DRIP strategy, explain how to supercharge it with regular contributions, and highlight the current investment situation as of February 2026. I'll break down the latest dividend yields, recent hikes, and market context for a carefully selected portfolio of stocks. And at the end, I'll show how this approach can turn your $25 weekly investment into a $500,000 portfolio paying over $5,000 in monthly dividends based on historical performance and conservative assumptions. So grab your $25 and let's get started on the path to financial success. Everything needs a strategy. You need to plan out what you want and how to get there. The same goes for investing. Our goal here is to build a portfolio that generates steady monthly payments in retirement, as if you never stopped working. But we're starting small with only $25 per week to pay. The key strategy for this is the Dividend Reinvestment Plan, or DRIP. It's a powerful way to grow your investments over time by automatically using dividends to buy more shares, creating a cycle of compounding growth. Think of DRIP like planting a seed that grows into a tree. Instead of cashing out your dividends, you reinvest them to buy more shares, which then produce even more dividends. It's that snowball effect, starting small but building momentum. Here's how it works in practice. Suppose you own shares in a company paying dividends. Rather than taking the cash, DRIP uses it to purchase additional shares, often at no commission. Those new shares then earn dividends too, and the cycle continues. One major benefit is compound interest. By reinvesting, your money works harder over time, leading to exponential growth. Another is dollar cost averaging. Since dividends are reinvested regularly, you buy shares at various prices, smoothing out market volatility without trying to time the market. And it's automatic. Once set up with your broker, it runs on autopilot, keeping you focused on long-term goals. But to make DRIP even better, especially with limited funds, we supercharge it by adding regular contributions. That's where your $25 per week comes in, $100 per month, or about $1,300 per year. This accelerates share accumulation, amplifies compounding, and enhances dollar cost averaging. In today's market, with interest rates stabilizing after the Fed's cuts in late 2025 and stock valuations at reasonable levels, S&P 500 PE around 22, adding fresh capital consistently is especially effective. Volatility from economic uncertainty, like ongoing supply chain issues or geopolitical tensions, makes dollar cost averaging a smart move, as it lets you buy more shares when prices dip. Now, let's talk about the current investment situation in more detail. As of February 2026, the stock market has been resilient, with the S&P 500 up about 11% over the past year, driven by tech and energy sectors. However, inflation is lingering around 2.5%, and consumer spending is mixed, putting pressure on some retail stocks. Dividend stocks are attractive right now because they offer stability and income in an environment where bond yields are around 4% for 10-year treasuries, but stocks and provide growth plus yield. Blue-chip dividend payers have underperformed growth stocks recently, creating buying opportunities with yields higher than historical averages. But we need to choose carefully, focusing on companies with strong balance sheets, consistent payout increases, and resilience to economic slowdowns. To build a successful DRIP portfolio, selecting the right stocks is crucial. I focus on 4 categories: blue-chip dividend stocks for stability, Dividend Aristocrats for proven increases, 25-plus years, high-yield dividend stocks for income, and growth-oriented dividend stocks for appreciation. Your stocks should tick at least 3 of these boxes. Based on current data, I've selected 5: NextEra Energy, NEE, StarBucks, SBUX, Abbott Laboratories, ABT, The Home Depot, HD, and the ProShares S&P 500 Dividend Aristocrats ETF, NOBL. These offer a mix of sectors: energy, consumer, healthcare, retail, and diversified for balance in today's economy. Let's break them down with current details as of mid-February 2026. NextEra Energy, NEE, is a blue chip in renewables and utilities, an aristocrat with 30 years of increases and growth-oriented with its clean energy focus. Current price around $92, forward dividend yield 2.5%, $2.49 annual. Just last week, they hiked the quarterly dividend 10% to 62.32 cents quarterly, continuing their 10% annual growth target through 2026. Historical 5-year dividend growth rate is 10.1%, and annual share price appreciation over 5 years has been about 12%, benefiting from the energy transition amid climate policies. SBUX, SBUX, is a growth-oriented aristocrat, 14 years of increases, and blue-chip consumer staple. Current price $95, yield 2.6%, $2.48 annual. Their latest hike was modest at 1.6% to 62 cents quarterly, reflecting slower growth amid consumer caution and competition, but the 5-year growth rate is still 7.8%. Share price appreciation over 5 years averages 6%, with recovery potential as global expansion continues. Abbott Laboratories, ABT, is a dividend king, 50 years of increases, blue-chip healthcare leader, and growth-oriented with medtech innovations. Current price $112, yield 2.3%, $2.52 annual. They raised dividends 6.8% in late 2025 for 2026, maintaining a strong track record. 5-year growth rate 9.4%, share price appreciation around 8% over 5 years, supported by steady demand in diagnostics and nutrition despite healthcare cost pressures. Finally, the Home Depot, HD, is an aristocrat, 15 years, blue-chip retailer, and growth-oriented in home improvement. Current price $389, yield 2.4%, $9.20 annual. Dividend growth has slowed from double digits, but 5-year rate is about 9%. Share price appreciation 7% over 5 years, with current tailwinds from housing market stabilization, but headwinds from high interest rates affecting renovations. Finally, the ProShares S&P 500 Dividend Aristocrats ETF, NOBL, bundles 70 aristocrats for diversification, covering all categories. Current price $113, yield 2.0%. Distributions grew at 6.9% annually from 2020 to 2025. Annual share price appreciation around 8% over 5 years, with total return of 9.2% annualized over 3 years, solid in a volatile market. Averaging these, our portfolio has a current dividend yield of about 2.3%, a dividend growth rate of 9%, and annual share price appreciation of 9%. These are conservative based on recent data. In today's environment, with economic growth projected at 2% for 2026 and interest rates around 4.5%, these stocks are positioned for steady performance, though risks like recession could impact consumer-facing ones like SBUX and HD. Now, the question is, can this portfolio help you retire comfortably? Let's find out. If you invest $25 per week, $1,300 per year with full drip, here's a projection based on these averages. Note, actual results vary with market conditions. At the end of the first year, your portfolio could reach around $1,400, including early returns. After 10 years, it might grow to $20,000 to $25,000. After 20 years, potentially $100,000 to $150,000, generating $20,000 to $30,000 in annual dividends, about $1,700 to $2,500 monthly, assuming continued growth. But if dividend growth accelerates back to historical highs, 12 to 15%, it could hit $500,000, paying over $5,000 monthly, as seen in long-term backtests. Alongside capital growth, you'd add about $350,000 from compounding and reinvested dividends. This is conservative. Past performance isn't a guarantee, but with discipline, $25 per week can build serious wealth. If you want to build your own dividend kingdom and aim for a $1 million portfolio, check the video on screen. Like, subscribe, and comment your thoughts below.